I'm a fan of the cold email, but not everyone is.
Yeah, maybe I will. That's a little loud. Maybe I will take the inverse of this question. There's typically two kind of broad buckets that we see companies through. There's inbound and outbound. So inbound, like Bar was mentioning, was through referrals, through other founders, sort of introductions, through accelerator programs, through other funds that we work with together. It's all people kind of within our network. So if you can do that directly, that's probably like the best way to get in front of not just us, but like any VC generally. Or the other side of the equation is there's outbound side of it. So you can ping us directly, content, open source, people talking about you on Twitter. It's sort of things that we would see publicly that might pique our interest to get it to reach out to you. So from a founder side and from a VC side, that's sort of the flip side of how we look forward and how you guys can reach out to us.
Can you hear me? Yep. All right. So one thing that I might add is it's actually one thing about getting in front of VCs, but the other thing is think about how to increase the signal. So meaning that a lot of reason that we care about the referrals and the intros from founders is because they actually increase the quality of your signal in front of the VCs. Other than that, right now we're at the event, so talk to us because our job is to talk to founders. So always go to events, always try to build something that's actually interesting and somewhat differentiated. One thing that we love is when we invest in early stage, founder profile obviously matters to a certain degree, but a lot of time we love to see demos. If you have wonderful demos, that 1 minute or 2 minute demo videos actually speak volume in terms of what type of stuff that you're building, and also to a good degree of what type of founder that you are. So probably think about those quality of signals. How can you increase that?
I love this point on increasing signals, and I think that you're right, intro is just one mechanism, but whether it's a design partner that you're working with or a demo, just what are the ways to show that this is interesting? Make sure to showcase that first.
Yeah, just building on the previous 2 points, I think it's really interesting because I rarely take meetings from cold emails, but the only type of meetings that I will take, and I will take every single time, is that if they have a very impressive demo, and then I'll always take that meeting.
By the way, can you guys hear us in the back okay, or no? No.
Not really.
Do you mind increasing the mic volume a little bit for all of us?
Hello, is this better? Okay. Perfect, yeah, sorry about that. Cool, yeah, another topic that I wanted to delve into a little bit is the investment process for VCs. I think this is an area that a lot of founders like asking, and it's very muddy. People don't really understand how VCs do investments, how do VCs evaluate founders, and what does the investment process look like for funds. Obviously, it differs from fund to fund, but I just want to get your perspective from our panelists.
Okay, I'm always first. So it doesn't just vary from fund to fund, it also varies from deal to deal. So to say that there's one investment. Can everyone hear me?
Hello? Hello?
All right, I'm going to project and we're going to see what happens. So, every fund has a different style of investing. I have friends who work at funds that they don't lead the rounds, and they'll meet a founder and they'll give a term sheet that day. And I'll meet people who spend a lot of time in specific areas developing theses and building really strong relationships over time. So funds have different styles, and then also at a fund there are very different types of deals. Like we said before, you get deals from all sorts of ways, including really, really high signal people that you trust, or people that you're meeting a first time and you need to develop even more trust over time. So for us, the way that a deal process tends to work, but this is not the case for all of them, is we get to know a founder over a long period of time. Every VC, they may weigh it differently, but cares about founder, product, and market. And so whatever you need to do to validate the three of those, we spend a lot of times in our markets. So we're very deep there, we have networks there. That's pretty easy for us to validate, and we spend a ton of time doing that all the time, and then really, really getting to know the founders that we invest in. That's what the process looks like, and multiple folks on the team will be involved in that process.
I'll try to speak louder, but for us at Leonis Capital, one of the advantage we think we have is that we're a pretty nimble team. It's Jenny and myself, we're two partners. So once we get to know a founder, we try to assess how good a product person he or she is. So that's why the demo carries a lot of weight. And then the other thing is like, we actually care a lot about what does the customer think of your product. Are you solving a real problem or not? So a lot of those type of questions can be answered through 2 or 3 meetings. The other thing that you might find how we think about investment a little bit differently is that we do a lot of homework in advance. So if you go to our website, we do a lot of open source research, and the goal of that is to have a prepared mind when we meet the founder. It's not so much that we take information from founders, we're keep learning. I mean, same with founders. But the idea is that when we see the right company and right one, we're able to write a check as short as a week. Once we get to that conviction level. So as a founder, when you think about like how to navigate the VC process, I think it varies on the fund size, who you're talking to. To Bart's point, right? Some funds are bigger funds, they have a lot more partners. Therefore, they might require consensus decision making, and you have to understand that. And the timeline to get to that finish line might be 3 months or 6 months. And there's some other fund that focus on very particular vertical that's in your area. Then that might be a good thing because they speak your language and they can hopefully come to a decision faster. So you really have to differentiate on what type of investor that you're talking to, because it is to some degree it's kind of like a sales job, right? So you have to understand your customers really well.
Yeah, I just want to add on that because for us, usually the first meeting is a very typical get to know you meeting, and the second meeting usually we're meeting with not just the CEO but the CTO, maybe the product person as well, giving them a lot of feedback and also telling them what we're seeing in the AI market because we do a lot of research internally, and oftentimes a lot of founders will find this as a value add to them even before we start investing in the company, and we'll ask them very in-depth questions, and this sometimes will impress the founders and they're like, wow, actually you know a lot more about the field than we were expecting.
Maybe to answer a little bit more tactically. You guys hear me all right still or no? Let's see if I can. Okay, maybe to answer your question a little bit more tactically, and I guess I'll try to project as much as I can. Typically for a VC, the first meeting, it's a 30-minute introduction call. You get to know the team, sort of intro. This is also why the demo is so kind of important in this context. And then usually for myself, I'll come with me, an associate of ours, and if I find it interesting, then I'll bring it up to the rest of my partnership. And at Race, there's 3 GPs, so then all of us would have a second follow-up meeting, typically a little bit longer, usually with you and your CTO counterpart. Thank you for joining us. In that one, then we'll go much more in depth into the product, the go-to-market motion, sort of your customers and all that sort of stuff. And if we are interested and want to move forward from there, this is typically when more kind of deeper DD starts. So technical DD, customer DD, legal DD, if we're truly interested in potentially leading the round, that's sort of the process from there. And I think for founders in the audience, there's 2 things you should keep in mind. One is just like we're looking for certain types of companies, you should also know what the VCs are interested in. Like for example, if you're doing a super late stage healthcare company, probably not interesting for us. We typically do early stage, pre-seed, seed, infrastructure, enterprise stuff. So it's sort of a match, like you kind of got to understand what you're doing and what we're interested in. And then second thing, it's not a single person decision. I have to convince the rest of my partnership. They have to convince each other. So it's a kind of a collaborative selling exercise to make sure we're the right partner for you and you're the right partner for us. So the whole process, that's kind of what it looks like, although it could vary from fund to fund.
Just building on that question a little bit, what are you guys looking for in AI companies? Because, a lot of founders will say, well, all the VCs are looking for the same stuff. They're looking for a data mode, they're looking for a superstar team. What are you guys looking for when you're investing in AI companies, and how is this different from the previous generation of software?
Yeah, sure. I'll take a first shot. So when we look at AI companies, we kind of look at, you guys hear me in the back?
Maybe you can try it
right.
maybe
Cool.
like this. That might be better.
So we look at AI companies from like a landscape point of view. There's infrastructure layer. A lot of foundation companies, those are the OpenAI, Anthropic of the world. They are building enablement API for application layer companies. So for us, we spend a lot of time looking at application layers because we think over the next decade or two, that's where the real value will be created and captured. So how do you actually build a moat in application companies? We actually have a research post and a webinar session about it. So it's actually a very deep topic that we spend a lot of time thinking about. But to summarize it, how we think about where the moat will come from in the age of AI or LLM-powered AI is actually, there is part of data. You actually need to get the proprietary data to some degree, but actually it's not as important as people think. As the previous generation of AI companies, that was mostly powered by machine learning. I think what we care about is, do you have the domain expertise? Do you have the know-how actually building a workflow function, enterprise SaaS, that's powered by LLM? So LLM can do a lot of horizontal things really well, and you don't want to be in the wrapper business of those APIs. But what you want to do is that, how do I think about, if I have to build the next version or next generation of Salesforce, Monday.com, how can I actually leverage the latest AI tech stack to build that application suitable for enterprise spending? So that's number one thing that we spend a lot of time talking with founders. And the second thing is that I think you guys see some demo previously with companies, agentic software. I think it's inevitable that is the future. AI is going to be able to take action and generate action on behalf of users. But on the path from here to there, how do you actually increase accuracy rate? How do you actually improve the quality of the outcome of the LLM model? Right now, it's a work in progress. But if a founder has a good idea or has some unique technique to actually build an agent to do that, reduce hallucination, it's actually quite meaningful for a builder and for investor us to think about. I don't know if you guys have anything to add.
Yeah. Maybe I'll take a little bit more tactical look at this. And sorry, I'm trying to talk as loud as I can, so hopefully this helps. For us, we primarily do leading seed checks and pre-seed type checks. And so, is this a little bit better or no? Better. Okay, good. So I'm just going to hold it like this. We normally do two types of investments: leading seed checks and participating in early pre-seed type checks. Let me differentiate the two, because I do think there's a difference between different stages of company. Typically, from a pre-seed perspective, we're normally looking at a team that's spinning out of the company with some domain knowledge that maybe has an early MVP, but is typically pretty early on in their product life cycle. So usually from that standpoint, we're trying to understand the team, the dynamics, the co-founders, how they came together, why they cared about the problem. There's usually not typically a lot of data or product or customers or concreteness, because it's typically pretty early. So it's much more of a team bet than anything else. And then once you get a little bit further along from a seed stage perspective, at that point you typically have a product, some customers, a few referenceable hopefully, maybe a few 100,000-ish sort of ARR in revenue. And from that standpoint, then we can drill much more into the product, the go-to-market, if you understand the ICP, what the customers are actually using for, how they came to you, sort of what you think in the future. Because for us, if we're going to lead the seed round, the thing we have to believe is you can get to an A, which the target is about 1 to 2 million ARR in revenue. So do you really have the wherewithal and the plan to kind of get you to that? So again, each stage is very different from the other one, and that's just focusing on the pre-seed and seed. There's a very different dynamic when you get to the A and the B and all that, but that's just kind of a zoomed in look on some of the things that we care about in those two particular stages.
This is a big topic. Does this help? I'm trying to copy. No? I don't know. Okay. So this is a big topic. I think that there are a few things to keep in mind here. One is that, like we said, team is always important. And as you, want to raise more capital and have more proof points, product and market, or especially product, become more important, as well as your traction. These are the fundamentals of investing regardless of AI, and they don't shift just because AI is part of the application. It may sound trite to say data and workflows, but it is a real thing. for most companies, it does not make sense to innovate on the AI. That's not going to be their comparative advantage. And so, I can give a lot of examples from the portfolio, but there are certain industries, for example, in healthcare, where the go-to-market is very complex, and having someone on the founding team who really understands that go-to-market is potentially more important than the most leading-edge AI scientist. That's not the case for every company, but it is for many. I'll give an example. We're investors in a company called Runway. They do video generation. And I think they've done a really, really adept job of combining product and research. And I think that part of what makes them interesting is there is a lot of work right now around video generation, but they are building a platform ultimately. They began by building a web-based, a browser-based video editor. And what is the platform of tools that you need to actually, for an end user that wants to edit videos, what is the end-to-end suite that you can build? And so having the user empathy of saying brighten a video is not binary, let's make a just-in-time slider, and several more examples is very, very important. So for each domain, what that customer empathy looks like is different, but it doesn't go away just because we're dealing with AI. I also think it's important, about a year plus ago, there were a lot of rappers. I don't think all rappers are bad if they're innovating in workflow and in data, but I think about when Notion put AI in their product and Microsoft Word, it probably killed a really large set of startups that were trying to innovate but didn't have a moat because they were using AI out of the box. So it's important to be mindful of who is likely going to move in that area too. Long answer, but there's a lot to it.
Yeah, speaking of domains in AI, what are some domains that you guys like investing in, and what are some domains that you try to avoid investing in AI?
I can go first. I feel like a rapper. Hey. For us, again, we tend to do
GPT rapper.
For us, we tend to do mostly lower level infrastructure and enterprise type investments. So anything above the hardware, really hard to compete against NVIDIA, and anything below kind of core enterprise application. So all the middleware infrastructure things in the middle. So like data infrastructure, transaction systems, developer tools, security, payment infrastructure, all of that stuff tends to be our domain. For ourselves in our own fund thesis, we don't tend to touch applications or consumer or healthcare because they have very different go-to-market that don't look anything like a typical sort of B2B or enterprise. But that's more just structurally our firm, not saying that's a bad area or anything, but that's for us like our typical sort of landscape. And again, a good thing for founders to know, every fund has their own particular area and things that they tend to like. So it is really worth when you're on a pitch meeting with us, not just pitching your company, but also asking us questions and really understanding, because what I invest in might be very different than what Bar looks at. But for us, that's our area.
Just adding on Chris's point, I think it's really important to do your homework before you meet with a VC, because there's a lot of founders who will come to me and they're like, hey, I have this hardware company or I have this biotech company, and I'm like, well, those are entirely out of our domain expertise and we don't really invest in those areas because, you can't really invest in areas you don't understand.
There are, what's exciting now is there are a lot of areas that are interesting. My most recent investment is in bio and AI, so I am interested in these areas where we have either untapped or not yet created large data sources where we've seen how powerful some of the scaling laws can be in the language medium. I'm interested in many of these other mediums where either someone private owns the data or high throughput experimentation can get you there. On the infrastructure side, just one note, we talked in the last question about moats. So there are things that change as the models get better, and the surface area of some of these organizations get better, and things that don't. So again, if we rewind a year ago, there were a lot of infrastructure companies that sort of hacked things like, okay, we're going to hack together a really long context window that this model doesn't allow us to deal with, such large amounts of information in the context window. And through that, we're going to reduce cost. Maybe that was not their entire value prop, but it was part of it. And we can imagine that context window is going to get bigger over time and cost is going to go down. So that's an example of something that I would not consider to be a sustained advantage in the infrastructure layer. In contrast, we've invested in several companies that are dealing with the data of enterprises. So I guess the most recent one we invested in is called Datology. And what they do is help with curation of your data for pre-training and fine-tuning models. No matter what happens at the model layer, our belief is that you'll always care about customizing to your enterprise data. We can debate exactly what that would look like, but these are just some of the things to think about. Pulling infrastructure as a specific example.
One thing I might add is, as early stage fund, investment timing matters as well, especially in the field of fast evolving AI. Like a category you might think is an attractive opportunity. As it turned out, it might just be transitioning phase that can be replaced or be built out by the foundation layer companies.
Okay, right now,
one example is like prompt engineering. So that was pretty hot like early last year, and now it's actually not such a big deal of a problem to solve. So that all of a sudden become not an investable area. So as early stage VC, how we think about is, unlike founder, that you're in this day-to-day and an operation mode, we think like 10,000 feet purview in some ways. So for us, we think foundation layer companies down the road is going to be commoditized. The model will improve, which will be good for builders, for startup founders, to leverage the API to build the next generation applications. API, the dev tool, is going to continue to be an interesting area because there's always need and demand for useful and sticky APIs for developers to deploy AIs faster, cheaper, and at scale. And then now the next question is that what does it mean to build the next generation of application companies powered by AI? I think we're actually in the very early inning of how things will unfold. For us, we think, sure, we're VC, we manage a fund, but frankly, we're in the learning business. We're actually learning alongside with you guys. So a lot of things that we think that might be true last year and quickly updated this year as well. So all of that to say, there's a lot of possibilities. As a founder, you just want to keep yourself intellectually honest in terms of two things. One is, what is the tech stack that can give you an advantage in outcompeting the incumbent software by delivering a 10x better product experience to the users? And two, what do you know in terms of go-to-market in the specific field, such as healthcare, finance, and legal, that give you a very big edge in terms of selling the software to the end customers? So those are things I think are North Stars in terms of building the company, and those are things that we like to engage founders in the topic.
By the way, on that topic, given the topic is the brutal truth about sort of founding companies and all that, one thing to keep in mind in terms of the timing side is startups in general also tend to take a lot longer than most people think. Like, for example, we are early seed investors in a company called Databricks. Everybody probably knows of that at this point. Databricks has been around for 14 years. By the way, they were doing 6 years of university research before that. So it's been about 20 plus years. So a lot of these things, they also take a long time. So one of the things we also like to look for, whether it's sort of expressed or not expressed, is also just the tenacity and like the determination by founders, because typically things are not going to go perfectly your way. It's going to take a long time to get there, and you have to really have the belief and wherewithal to take it through all of those kind of messy stages in between.
Yeah, I love that point. And I mean, you can see Databricks. I don't work with them, but they acquired Mosaic, and they're making a lot of changes. So tenacity and agility go hand in hand, because the market does shift over 14 years, and you need to be prepared to think ahead and be leaders in that market shift. The other thing I just wanted to note, we talked about what does the investment process look like. One thing I just want to add is that typically when we're investing in companies, we do a lot of introductions, and that is meant to be, it does two things. One is it's hopefully very helpful to the founders that we work with, because they get to meet potential design partners and people in our network. But the other is, we get to hear feedback from our network too, frankly, and so we get to learn. We can pitch a founder's vision on their behalf, but it's never as good as when it comes from them. So their ability to pitch, how much that problem resonates with people who are potential buyers or in their domain. And so it's just one thing that I didn't mention in that process, but I think it ties all of these together in terms of needs and kind of the practice of the process.
Yeah, I just wanted to add on the topic of what we look for and like also what we try to avoid. Just a reminder, like all four of us on stage are primarily B2B investors. We don't really do a lot of like consumer investing, and we do a lot of investing in, sometimes enterprise SaaS in the case of me and Jay, and also like in the case of like data infrastructure and developer tools for the other two funds. But I think regardless of what area we're investing in, the basics of venture investing still holds for AI. A lot of AI founders will come to us and they're like, hey, we're using an AI solution for X, Y, or Z industry. And the brutal answer is, this industry is too small. There's not enough of a market to make this thing venture backable. I don't want to like name any names or like give any specific industries because I don't want to discourage anyone from innovating, but there are some industries that are too small to be venture backable. And also there's a lot of industries where there's not a lot of willingness to pay. And for example, a lot of the companies that we invested in our Fund 1 or even like previously were selling to game studios, and game studios, they don't have a lot of capital. They don't have a lot of money to pay. And also the same problem holds for education startups. If you're trying to sell to education, if you're trying to sell to like parents or students, in the US, people don't like paying for education. They don't like paying for an education app. That doesn't mean that you can't have a successful startup, but it does mean that it's going to be a lot harder for you to succeed in those areas where people are less likely to pay versus like areas where you're selling to an enterprise, there's very stable revenue, and these people are willing to pay for your product.
I just want to add something there on LLM infrastructure and LLM ops. If you go back, I don't know, like 6 years, ML ops was this really hot thing that everyone invested in. Basically all the infrastructure around getting machine learning in production. There were some successes there, but I would say relative to expectations, not to be downer, is mostly a flop. And this is a function of many things, including that there just was not as much ML in production as people expected there to be. A lot of things have changed, obviously. It's much easier to at least get a demo and productionize ML with different skill sets because you do have access to these APIs. But it's not, the LLM ops, we'll call it market today, is not an enormous market in terms of enterprises. It's a market that is having a shift and could be tectonic and huge. And so I guess one brutal truth is, as a venture investor, we can take bets on markets that have potential to be massive. I believe it will be massive. As a founder, that's your one bet. And so, yeah.
Yeah, the last topic I kind of wanted to touch upon before we open up the stage for Q&A is the question of valuations, right? Everyone's talking about AI valuations are, out of the roof, it's too high. How much do you guys care about valuation, and like what should founders ask for at the seed or pre-seed stage in terms of valuations?
Me go first. Complicated subject. Let me try to parse it out a little bit. If we're going to invest and lead in the round of the company, me as the investor, I don't just care about this round, but I also care about the next round and the round after. So for example, if I'm leading the seed round, I care about the A and I care about the B. And so if you get too high of a valuation in the seed round, like for example, if you raise at 100 million post on a seed round, typically each round up, you're looking for about a 3x kind of multiple. That'd be healthy. If you can get above that, great. And so if you're going from 100, you have to go to 300 by the A, which is a really, really, really hard step function to get. if you're looking at it from a revenue multiple basis, you got to be doing 20 to 30-ish million in revenue. And so from a seed stage perspective, that's a huge ramp up. You might be able to achieve that, some companies have, but it's very, very, very rare. And so we're pretty valuation sensitive, because again, we would be on your side afterwards, and we're looking for kind of healthy multiples on the way up that are not too egregious from either side. So to put some real data on it, from a pre-seed side, what we typically see is companies raise 1 to 2 million bucks on, call it a 8 million on the low end post to a 15 on the high end sort of post. That's sort of the range-ish. On the seed stage side, median is maybe 2 to 3 on 15 to 25. Sometimes it could step up a bit. It could be 3 to 5 on 20 to 30, but that's kind of the normal range-ish. And then by A, if you're really happy, you're doing kind of 80 to 100. And again, hopefully you're doing the 1 to 2 million, sort of growing at 100% post with a real go-to-market plan to kind of take you on afterwards. That's like the nicest sort of rise upwards. Again, it's not an ownership maximization from our side, and it's not a capital maximization from the other side. But when we lead, it's always kind of a discussion back and forth between the two of them. Because again, once we invest, we're on your side. All your problems become my problems, and I have to worry about all that sort of stuff. And so like I try to make this a collaborative exercise as much as possible to sort of figure it out and not just say this is the number per se.
Yeah, I would say Chris is spot on. Like this is a multi-dimension thinking. It's just not. It's not a one number for now. It's actually, if you think about it, most founders think about valuation and the amount raised as dilution at the C round, A round. I mean, yeah, it is. But you have to remember, a lot of valuation set before IPO, before the company actually exit, it's all fake. It's all, kind of a benchmark number that you're setting yourself up for the next fundraise. So to Chris' point, that's absolutely correct. Like if you raise at 35 pre-seed valuation, so what that means is that at the next milestone, you better have the business at 100 million plus in terms of valuation. And that demand for certain type of capital efficiency, certain type of revenue number to get there. And I can tell you, it's very hard to have that expectation set so early on, so high early on. Now, I can. More recent example is in the bull market of 2021 and 2022. Most companies are very good at fundraising or have easy time fundraise because that's the time interest rate was low and there's a lot of enthusiasm going to the private market side. I can tell you, data suggests that a lot of those companies who make, now looking backwards, mistake of raising a too high valuation, they cannot find the next round of financing in 2023 and this year. So what that means is that the company might have to go out of business. So one single point decision actually matters a lot. Now that's like a very macro kind of comment on the valuation thinking, but it is very important that you actually go through the investment partners, that someone you can see, to Chris' point, once you receive the term sheet and sign the term sheet, that VC firm, that partner is going to be on your team. And what we think about is that, okay, so we just put $2 million into your company at pre-seed round or seed round, and now how do we actually work together as a team to get you to a Series A with a good firm, with a good traction, and how do we get to that milestone? So we want to make sure that the bar is not set too high. Now, one last point with AI, right? AI is hot, and I hate that because it's so hot, and it's such a big buzzword, right? People have different ideas about AI. Machine learning could be AI, computer vision is AI, big data sometimes got looped into AI. So as a founder, I can see the rationale of labeling yourself as an AI company, but I think the true soul searching is that, what type of company are you? Like, because the real technical investor, they will find out. And they're not going to give you that valuation that you're looking for. So the idea is that don't set yourself up so high so that you cannot get to the you cannot overcome the hurdle to get to the next milestone. The reality is that set the bar to a reasonable amount so that you increase your chances to get to Series A, Series B, and beyond. And that's actually the most important thing when you think about early stage financing.
So I agree with the macro is important. Even though AI is hot now, it may not be in 2 years, and the reality is if you go out to raise now, in 2 years you're going to probably have to raise again, and or plus minus several months. But if you're trying to do something like 3x your valuation, the bar is higher as you raise at a higher cap. Very tactically, kind of two things that, because I think the two of you did a great job covering that. Two other things. One is, I understand why some AI companies need to raise so much. We used to have this paradigm of money into humans, into output, very rough. And now for a subset of the companies that are training their own models, it's money into compute, into output, and that costs a lot of money. I think that it can be very, very fruitful. Not every AI company needs to do that. And there are a lot of challenges there because the half-life may be short of the models that you train. That's a whole other discussion. But from a first, if I were to think how much do I need to raise, it's a collaborative discussion. The way I would think about it as a founder is, what are the milestones I want to achieve between now and my next round? How do I work backwards from that? And what is the capital that I need to execute on that plan? So for some companies, if it is, training your own models and it's very, very expensive and that's what you need, that's what you should do. For most companies, that's not what you need, and so I think really working backwards, giving yourself some cushion. I think paying yourself so that you're comfortable too. Startups are stressful enough, but that is how I would think about it. And we also look for that too in investment processes. How thoughtful are you on, if it's a pre-seed? Sometimes it's the experiments that you want to run between this pre-seed and the seed. If it's the seed, maybe it's revenue milestones and hiring milestones or something else. But what are those milestones? What do you need to get there? And then what is the budget that you need? How do you add a little bit of cushion and stay reasonable so that you can kind of make the leap to the next round? Yeah.
Maybe just double click on that real quick. I think when we think about pitching for VCs, one question at least I love to ask is that why are you raising 2 million? Why are you raising 3 million? So a thoughtful founder will break down the thought process, like Bar was saying. Actually, what do you actually need to get to the next milestone? Why are you raising 2? Why are you raising 3? Why not just 1? So that's something that you want to actually be thoughtful about. And the opposite example is that, founder would say, my peers did the same thing. Look at this TechCrunch article.
My roommate raised 9 million.
Yeah, they raised 3 of 9 at this valuation. That's not a good answer. That doesn't show your thoughtfulness in terms of building out a sustainable business.
Just to add on that point, the reason why VCs care a lot about how much you're raising, in addition to what valuation you're raising at, is because if you're not careful with your capital, you're not going to be careful with their capital. And if you're not capital efficient, that means they're going to get very, very, very diluted when you're in your Series C or Series D. And no VC wants to see that. They always want to see founders be very careful about how they spend money. And that's why when a founder comes to us and says, hey, I want to raise this massive round, even if it's not at a super high valuation, that's oftentimes a red flag, because that means you're going to squander a lot of money. Cool. All right.
The opposite can be true too. Sometimes being too stingy can also hurt you. So I think just thoughtfulness and reasonableness and being able to talk about why.
I think it's good to do both bottoms up and kind of tops down. So bottoms up, what do you actually need operationally for the company? And then 2, what are peers, kind of other people, whatever, doing? And it should kind of make sense for you. If you just picked the number because you thought it looked cool and you burned it all, well then your company's going to be dead. So the amount of capital has to be sufficient enough to run the business, because at the end of the day, it does need to translate into revenue for the company, because once you get to A and B and C and beyond all that, they don't really care about the vision and all that crap. They're going to look very specifically at the revenue and the business and the company, and that's what you're going to be measured on. And so all the pre-seed and seed and A and all that is just an effort to get to an actual company. Sometimes people forget that, which is a little scary.
All right, I promised us 15 minutes at the end for Q&A, so feel free to let us know if you have any questions, and one of the people here are going to help us pass the mic.
Testing. All right, great. Thank you very much for this talk. This is awesome. You said one of the aspects you care about is the founder. I heard founder singularly. Sam Altman did say that there will be a time where there's a billion-dollar company with one founder. That's probably not what's happening though when you come across like these different companies. So like, what's the heuristic? Do you see the one person, or do you see 2, 3, like for the team size?
Yeah, so the question is, are we seeing one-man unicorns, basically? Do we see like a unicorn company being founded by like 1 or 2, maybe like 3 founders, and no employees, not raising much money, just being very capital efficient?
I think this is a very interesting point, something that we're pretty excited about with this paradigm change. What LLM is able to enable the next generation founders is going to be very capital efficient, because it can do a lot of things both internally and externally by establishing a much higher ROI. Jenny and I, we kind of smile because we actually did the report on the AI 2.0 companies, how they differentiate both from the tech stack and also from the capital efficiency side. In our Fund 1 portfolio companies that we invested 3 years ago, we're already observing a good amount of companies actually able to scale from $0 to 30 million ARR with a limited number of employees. And there is a deeper reason behind it, both from the tech side and the operation efficiency side. But I think going forward, this is a trend that's gonna accelerate, and we'll see probably more of those highly capital efficiency company coming out of building on this tech stack.
Yeah, I think like one-man unicorn is still a little bit of exaggeration. You definitely don't want to start a company alone. It's a very, lonely process. All right, let's take a couple more questions.
Hi, thank you guys again for a fantastic panel. With your current investing companies, what are you seeing as the most successful sort of go-to-market channels? I'm a founder selling to e-commerce companies. Right now I'm really struggling with cold email, and I wanted to kind of understand sort of what your perspective is on successful go-to-markets that you've seen.
Yeah, so the question was, what are some successful go-to-market strategies for AI companies that we're seeing?
I don't know if there's a singular most successful channel, but I'd say the 3 probably most typical ones, again in infrastructure, B2B, enterprise type stuff, tends to be either open source, PLG, and SLG. Open source, you get a big bottoms-up developer type adoption that you could use then typically to layer on SLG on top of that. PLG is a little bit more for like the smaller SMB, mid-market, individual type thing. A lot of investors tend to type of poo-poo that, but like it does work if you can kind of get it at scale. And then SLG will probably never go away. This is bigger enterprise sales. Hard to start with that in the beginning, but once you get that rolling, that tends to be longer, stickier annual contracts that are really embedded into the organization. I'd say for each product and company, one of the channels tends to map onto them a little bit better. It's not like one is better or worse than the other one, but one tends to kind of be the main selling point for each kind of company that we're looking at.
All right, this lady over here.
Thank you. So in the introduction, Jenny mentioned that all of you are investing in similar companies and similar stages. So what do you think is different about your firm in terms of your approach and perspective in investing in these AI first companies?
Yeah, maybe I'll take that that question, because I did like pretty deep research into like all of the firms before organizing this panel. So essentially, we invest in the similar stages, similar areas. The difference between us at Leonos versus Amplify and Race is that we not only invest in infrastructure layer companies, but also invest in application layer companies. Whereas like Race probably wouldn't invest much in application layer companies. It's not one of their focus. And I'd say like people have different strategies. Like for us, it's like more research driven. So we try to understand the technical side and the market side and do a lot of internal research. Curious to hear you guys like what your differentiation is.
Probably the biggest thing that we talk about is our whole big thing is really go-to-market sales. So we actually have a whole internal go-to-market head of sales team with the firm itself. When we initially hired them, we initially thought it was going to be a little bit more best practices, learning, teaching, all that sort of stuff. But honestly, we threw that out the door. And what our go-to-market team does is we actually help forward deploy them into our companies to really help them understand sort of ICP, sales process, core contracts, moving to annual contracts, making sure that all contracts are on our paper, liability, all that sort of stuff, because all of this matters until we get to the A. So again, our whole goal is to get you to A, so 1 to 2 million in ARR, and you have to have a workable plan and team in place in order to get that. And so we will take a bit more of an active role in order to get you there. And the reason why we do so is because most of our founders tend to be pretty technical in nature, so they usually never really run a go-to-market campaign or process or team or any of that. And so we take a little bit more of a heavy-handed stake on that to help them kind of get the first person or so on there. But that tends to be kind of our thing that we like to do.
Yeah, first of all, I love the question because we're up here talking about differentiation from startups, and it's very valid to be like, all right, well, what's your differentiation as VCs? I think that's great, and you should always be asking if you're interfacing with VCs that exact question. So I love that. At Amplify, we focus on technical founders and platforms. So, that could look like infra, security, dev tools, distributed systems, a lot of data and AI, which is where I spend most of my time, and we go incredibly deep in those networks, kind of know the folks working on open source projects, know the folks in academia around the world, heads of AI at various orgs. So some of it is really deep network and understanding, and when you're a focused fund, you're able to immerse yourself there. And then the whole fund is built around supporting that persona of founder. So, part of it is we go there, we help a lot with go-to-market, with hiring, we have deep networks here, but we also have a full operating team, so I won't go and list them all, but in my opinion, like the top talent person in the Valley, go-to-market, who's helped our companies negotiate massive deals, sales, someone who was a VP sales and will work with company hands-on. I don't know other folks who have developer marketing in-house, but because so many of our companies are open source and developer marketing is so important, we build the functions that are relevant for the types of companies that we have, and we try to find the best people in the world to really aid our companies in that 0 to 1 phase there. Yeah.
Maybe one other small point here too. Again, I'm not biased or anything, but all the firms up here are pretty good. And if you're a founder and any of us give you a term sheet, you should probably be pretty happy. Evaluate all your choices. But to some extent of it, it also comes down to the personal relationship between you and the partner. Do you like the person? Would you call them if you're in trouble? Do you think they have your back? Do you trust them? A lot of this soft stuff, which doesn't really matter all too much until it really, really, really matters later on. And so much about the decision on what VC to take is not just the capital, the services, it's all that. A lot of it comes down to the personal decision on, do you like the other person? Because again, once you pick your investors, similar to marriage, you kind of can't get divorced with them. You're sort of stuck with them forever.
And sorry, I'll add just one more thing, which is, we say that we diligence and we make introductions to our founders, and it helps with the signal if someone in our network knows them. Similarly, anyone that you take capital from, you mentioned it's a long marriage, there's a soft component, diligence them. So this is a really big part of it too. Founder references, people in the network, anytime that we're doing a deal, we're putting it all out there. Ask anyone anything about us. Meet people that we work with. That's a really, really big part of the selection too.
All right. Any more questions?
Okay, this question is specifically for pre-seed round. So I have some experience in China, and for the pre-seed round, in China, they typically expecting the founders, very stingy and even take a very low pay or non-pay. But you mentioned too stingy in Silicon Valley is not good, and you said lavish is not good. So at what kind of, ballpark percentage you spend on the team development, and on what ballpark percentage you spend on the marketing?
Okay, so the question is, for pre-seed companies, what is the percentage of the capital raised you want to spend on hiring versus marketing?
So when it comes to payroll and salaries, I think at early stage, pre-seed stage, you definitely want to pay yourself. I don't want to work 3 jobs to make your startup work. That doesn't make sense. you want to pay yourself to a reasonable amount of salary, so that, but it's not like your Google type of salary or Facebook type of salary, because there is a premium in terms of the equity that you're getting in the startup that you're working on. And also, a lot of times, like, we try to assess how much a founder can share the vision in recruiting the team. Because if you compete the next level A+ engineers to your team by paying the same amount of salary, it's probably okay, but not ideal. Ideally, the type of founder that we like is actually able to share the vision and convince that 10x engineer to join you below the market rate. And that tells a lot about how you actually lead the team, how you sell your vision, and actually how you get your team to be buying into the equity of a startup company. So there is no hard set rule in terms of what percentage or below percentage of a salary you pay yourself. But I think just as long as it's reasonable, and VC is not gonna kind of nickel and dime and say, hey, why don't you lower your salary by 10%? No VC usually do that, so I don't think you should worry about that.
I think Pilot recently did a survey on this, which was actually pretty good. For an average pre-seed co-founding CEO, I think the typical median average is about $125,000. So again, it's not very high, because most of your compensation is in the equity side of the equation, not the cash compensation side of the equation. And by the way, if you're an early pre-seed founder and you're trying to maximize your cash compensation and you don't care about your equity, that's kind of a big red flag for us too, because we want to be aligned on the equity side of it. In terms of your employees, that's a completely different sort of question, if you will, because again, they're never going to have as much equity as the founder, and so their salary is going to be maybe not full market rate, but a little bit less than market rate. But you can't be too cheap with your team, or else you're not going to get great people. But in terms of the founder itself, again, we usually see pretty low to modest in the beginning until about Series A. Then you can start paying yourself closer to a real-ish salary.
All right, let's try to take in a couple more questions.
What are some of the exciting use cases have you found in specific industry verticals? I think the data is critical, and also industry know-how is also important. But for startups, usually the data are with the incumbents. So startups almost need to accumulate their own data in day one, so it makes it really difficult. But what are some of the cases you have seen that overcome this barrier?
Yeah, so the question is, like, how do startups overcome the data barrier? Like, how do they collect data for fine-tuning or training model?
Areas that we see a lot of companies are doing, going to large verticals, are finance, healthcare, and legal tech. So I can't tell you how many times we got pitched by AI agent that's going to replace our analyst. There's a lot of AI companies trying to sell into financial institutions. So there's a lot of those type of companies. But the part that kind of take us at a higher level is that actually you can build a software or some sort of AI agent around the financial institutions. But how do you actually make the output that's usable, that's accurate, that does not have a lot of hallucination? That's a key. Right now, we haven't, to our knowledge, we haven't seen a company that's truly AI agent yet that can take action 100% correct on user behalf. That's why I say it's still early days in terms of the agentic software. But in terms of vertical directions, those are the ones that we are pretty interested in.
All right, let's try to squeeze in one more question.
Can you guys hear me? Okay. I'm curious about your definition of pre-seed, and then where that differentiates with the what do you call friends and family round. Like there's a pre-seed. It seems like it's the definition is somewhat controversial. So I was just wondering hear your perspective about what's the traction for pre-seed.
Yeah, that tends to be a pretty gray area, so thanks for bringing up the question. Again, I'm stripping off the friends and family, and I'm just going to look at pre-seed, seed. And so the difference between pre-seed and seed, in my opinion, and feel free to chime in, pre-seed is typically a very early team, super early product, MVP, maybe prototype, maybe something working, maybe not. probably no customers, maybe some early POC customers, but pretty early on, pointed to a pretty big market, but everything's like much more conceptual in nature. And then typically by seed, you would have a product, some referenceable customers, a little bit of revenue, call it like a couple $100K, maybe to upwards of $300K kind of ish in revenue. It's still very early on, but there's something much more tangible to look at, to demo, to see, to all that. And so the sort of difference between pre-seed and seed is that conceptualness to realness. But again, it is a squishy definition, so it's a big gray area. Sometimes companies are further along, so it's not a hard, fast kind of rule. It's much more of a gray area divide.
All right, well, thank you guys all for being here, and let's give a round of applause to the panelists.
Thank you so much, Jenny, Jay, Chris, and Bar, for the great sharing, for the VC perspectives on what they really want in AI for startups. And now, here we have some small gifts for you from the organization.
You're good.
And next, let's welcome our Mon Fan, the co-founder and CMO of Mountain Lion, to give us a speech around underestimated potential, the role of domain-specific LLMs in driving a